Hello everyone, and welcome to today's session with David and myself. We've changed the time, as those of you who come regularly will know. Usually we do this evening for us here in the UK. It's at the end of the US session, but we wanted to do it this afternoon for a number of reasons, which I'll go into once I have drawn your attention to the disclaimer, which you should be able to see on your screen. Yes, I can see David's. And also I wanted, as I said, lots of reasons why we've moved to this particular time this afternoon. But just to recap, could you please just take a moment to read the disclaimer? As you know, trading can be an extremely risky business. Please don't even think of using money that you cannot afford to lose. So I will take that away, and I just want to run through a couple of things for those of you I know who may be coming along for the first time, what it is that we want to achieve in these sessions, and essentially is to present to you and explain to you the methodology that David and I, David is my husband, we've been using for the last 20 odd years of volume price analysis and how we apply that to the markets. Now in this session, we will only be looking at commodities, the indices and the US stock market in particular. You can apply VPA to the Forex market, but that is another session that we hold. And in fact, this week it's tomorrow morning when we look at the London, in the run up to the London Open. And as you can see here, the concepts are explained in the book, A Complete Guide to Volume Price Analysis. I'm really, really proud of this book. It's got over 275 five-star reviews. It's not a new methodology. It's understanding this very intricate relationship between price action and volume, and how, if you can learn to interpret it correctly, will really open your eyes as to where the price, what is going to happen next on the chart. Because as a trader or investor, that's really all we want to know. We look at a chart, regardless of the time frame, you say, well, where is this going? And as I said earlier, this is not a new methodology. If you like, our take on the relationship of volume and price is very much based on the work that was carried out by Richard Wyckoff, a little bit of Richard Ney, and very much pays homage, if you like, to the great traders of the past, such as Jesse Livermore. And if you've ever managed to read some of Jesse Livermore's original work, you will know how important volume was to him. Now, of course, in those days, it was reading the tape. And this particular book has also been translated into Japanese and Chinese. So there we are. We start with volume price analysis. There is a complementary book. There's a companion book to the original complete guide, and that is a book of worked examples. And we can see here, this is the investing and trading using VPA, and there are about 200 examples drawn from across the markets, but primarily in this book, because it complements the original VPA book, it's primarily stocks and commodities. And what we wanted to show in this book is how it can be applied, as I said, to all markets and time frame. And that's what we're going to look at in this session. It's what we look at all the sessions, and we've got some other things that we want to cover as well, but that is principally at the heart of these webinars. And what we use, the platform that we're using at the moment is NinjaTrader. We are looking to at TradeStation as well, because to help us, if you like, to support us in what we do with VPA, David and I have actually developed a whole suite of very specialist tools, and the ones that we look at here for NinjaTrader are only available, as I said, on Ninja at the moment. We use MT5 and MT4, and we will be looking to develop them for TradeStation as well. I want to just mention the cost of the package. This is the whole 9 set of tools, which comes to $749 as a complete package, but you can buy them individually. And I suppose if there's one indicator that I think every trader should have, regardless of what you trade, and that is our volatility indicator. And you'll see why once we move over to the charts, but I know some of the attendees sort of go off maybe halfway through, and anyway, I just wanted to highlight that to you today. This is the first time we announced it last week, is we've actually created a chat room for VPA traders, and that is traders and investors really from across all the markets. It is by invitation only. You need to drop me an email. That's anna@annacooling.com, and if I can find the let's have a look. Let me see what it looks like. This is what it looks like in the room itself. We have obviously contributions from our traders. There's crypto traders there. There are forex traders, stock traders. It's got some fantastic features. This particular platform. There's an economic calendar. There's all sorts of widgets that you can use. It's got stock screeners. It's got stock trends. But it's really the place where, as I said, David and I want to try and have just a central hub, if you like, for a VPA, and we put up charts, and people leave questions if they leave comments or questions. David and I go in and add our own contribution, as it were. I'm just going to stop there and pass over to David, and then, as I said, I just want to go through some of those reasons why we are running this webinar at this particular time, and also what to look out for today and certainly the rest of this week.
Thanks, darling, and a very warm welcome to you wherever you are in the world. It's a lovely afternoon here, a bit cold, but a beautiful sunny day. So I hope it's nice where you are, and a very warm welcome. Just very quickly, I won't go on. If you do have any questions on the webinar, just drop them in the chat box. We're more than happy to answer them there if they're short questions, or if they're longer ones, then we will answer them on air for you. So happy to answer your questions, whatever they may be. I'm going to pass back to Anna. Anna's on, are you on Ninja 7, I think? Yeah, Anna's on NinjaTrader 7. And I'm on Ninja 8, so you'll see some differences between the two platforms, but primarily we're on NinjaTrader for the whole of the session. So I'm going to pass back to Anna, and we will get going.
Really, the first thing I just wanted to highlight before we start is that obviously, given the volatility that we've seen in equities, there's all sorts of reasons for it. A couple, if you were with us about 2 or 3 sessions ago, I did mention something called the October effect, where some of the biggest crashes in the markets have happened in October. But I also said that September wasn't a particularly good month for stocks. And I think there's that quote from, who wants to give that quote for Warren Buffett? Says he goes through every month of the year and said they're all dangerous for stocks. I can't remember who actually said that. Maybe somebody knows that and can put it in the chat box. But essentially, as you know, there's been a lot of volatility, which if you're a trader, it's fantastic because it's a trading opportunity. Because as a trader, it doesn't matter whether the price is going up or down. If you're an investor, of course, your emotions are going to be very different because you don't buy something in the expectation that it's going to go down. You buy something in the expectation that it's going to increase in value. Now, we are coming to the end of the month. We've got a couple more days to go. This week is actually quite important because we've got NFP on Friday. There's all sorts of political things going on. We've got Brexit here in the UK. There's all sorts of hoo-ha going over in Europe as well. Merkel is in the news today. The problems with Italy. Now, you may think, particularly if you're joining us from the States, you think, well, how does that affect me? Maybe I'm looking at equities and what's going on in the rest of the world. Well, the thing is, it does have a huge effect because the global markets, financial markets, are so intimately intertwined, much more so than when David and I first started. First of all, the indices, they trade 24 hours a day, so the traders coming in at all different times. Of course, we have the physical open where you have the biggest volume coming in. Everything is interconnected and interrelated, and even if you're just a stock investor, for example, in the US, and that's all you're looking for a good stock, well, for example, what does the US dollar do? Because if the company that you're looking to invest in earns most of its income abroad because of exports and what have you, knowing what the US dollar is doing, the value of the exchange rate for the US dollar is going to be hugely important as well, because it's going to affect the bottom line. And then you have to look at the broader question of sentiment. And what I've pulled up here, this is actually from my Talking Forex feed. It's a general news feed for Forex, but as you can see, it brings in all sorts of other markets, because what we want to do all the time is we want to know what is the sentiment of the market. As David has said many times before, and we always reiterate, this is just about money flow, and money is either looking for a return or people are looking to protect it because the markets are worried and nervous. So, you know, when the market opens, you can see here, it says here the headline, US mix versus the G10, the havens. What is a safe haven? Well, the Japanese yen is a safe haven. You could be asking yourself, why is the Japanese yen a safe haven? Well, it just is. It's just one of these currencies. It's like Janus. It's a safe haven, and it's also a funding currency for risk. Gold are weak. Then you've got the Canadian dollar, which is highly correlated to gold and vulnerable to broader market sentiment. If the market's not going anywhere, oil isn't going to be the demand for oil because nothing's going to be moving in the economy. And as I said, it's just a snapshot of what we can expect in today's session. And of course, after last week, if you looked at how they all ended up, you will see some huge doji candles, a ton of volume coming in, and of course it's all against the background. We've still got earnings coming out for some very big companies. I think Apple reports later on today, and then we've got Facebook as well, but I think Facebook is tomorrow. So, you know, the whole, if you like, the whole atmosphere, the mood of the market is really it's quite fragile, it's quite nervy, it's quite fractious, and all that is going to be reflected in the price action. But if you can understand the relationship between price and volume, you're going to be streets ahead of most of the other, in fact, all of the other traders that are out there. I'm just going to close down. I'm just going to get some charts up. I'll just pass over to you, darling. Is there anything you want to say on that?
Sorry, I'm just deciding which screen to go to. No problem. Okay, we're going to start with the indices and then I think go back to Anna on some stocks. I've got some stocks as well. And it's been an interesting session as well because we're now well into it. We put the clocks back an hour, so we're actually 2 hours into the session, which is nice. And we've had some good moves as well. So let's switch over to my screen. Just going to switch off for a minute.
That's brilliant, because what I've also been doing is I've actually picked out some just 1 or 2 stocks, not at random. I'm actually trying out, somebody sent me in the industry, they sent me a prototype of a new screener, which basically looks at anomalous volume patterns and volatility, and I've just been checking it out, and I've pulled up a few examples, some very interesting examples. One of them is AKAM, another one is Verizon, and I think I've got MSPR. I think you've got that one, David, haven't you? So we're just going to perhaps look at those later, and I also want to have a quick look at gold as well. But I'm just going to pass over to David because we've been looking at the YM. The YM is an index that he and I sort of dip into on a fairly regular basis because it's a bit more steady, if you like, certainly than the S&P and the NASDAQ. But I'll pass over to David and he can explain all.
Thanks, darling. I'm just going to switch screens from Ninja 7 to Ninja 8. Just click on that. That should bring my screen up. Charlotte, I'll get Anna just to check that for you. Okay, fine. But you should get that again. So apologies if it may have gone into the bin or spam perhaps, but we will send that again for you. So don't worry. Okay, just to orientate everyone what we've got here. I've actually got the ES up as a starting point, but I've got all the others as well. I've got the YM and the NQ. So I've basically got all three primary indices here. And just to point where we are on the top left, this is on a 3-minute time horizon running the tick speedometer indicator to give us a heads up in terms of tick count, which is down here. Because on the right hand side here I've got both the Renko, but I've also got the tick chart for the ES as well. And all these charts are linked with this little green link up here. So if I change from one instrument to another, they'll all change automatically. So I've got the tick, I've got the Renko chart running there. Bottom left, I've got the 5-minute. Just pop that up because that's been probably the most interesting time frame this morning, or certainly this afternoon. And then down at the bottom right, I've got the 15-minute equivalent of the ES. And really, just to start with the 5-minute time horizon. This is the open of the US session for us in the UK. It's now 13:30 as opposed to 14:30, which is normal because we put the clocks back. So this has been running a couple of hours. What was interesting about it was the start of the session. We had this massive amount of volume come in, which, as Anna said, is always the case when the physical market opens on top of Globex. That's what you expect to see, this inrush of volume, ton of volume coming into the market. And inevitably you get volatility, but the first candle was the most interesting one where they had this huge amount of volume coming in and this really weak effort to rally. That was followed thereafter by a load of volatility candles. Again, not great, not a huge surprise. But thereafter what followed, and as Anna said in the introduction, one of the most powerful indicators is the volatility indicator. It will save you more money and more pain and more heartache than you would believe possible for an indicator that I think costs $57 off the top of my head. And when the volatility indicator is triggered, this was a classic trap move. It happens all the time. The big operators, the market makers, depending on which market you're looking at, they come into the market, they're selling heavily, which is what this was all about. Heavy selling on the open. This is a trap move. The volatility indicator is triggered. The expectation is the price action will at the very least reverse back inside the spread of the candle. Not always, but often this is the case because that is when the insiders are participating, and it's a classic opportunity for them to trap you into a weak position, which is precisely what happened here. As soon as I saw that coming in, you then look at the multiple time frames. Are we running into areas of potential resistance, for example, on slower time frames? This is where the power of using a multiple time frame approach really comes into its own, because what is signaled on a 5-minute chart may not necessarily be self-evident on a faster time frame or a slower time frame, but those time frames together consolidated give you this three-dimensional view, if you will, of what is going on in the market right now. We then get the rollover. We come back down into the volume point of control, which is here. We've got an absolute stack of volume. You can see it going right the way out here, past the left-hand side of the chart. If I pull it over a bit, find out where the end is, it's way over there. So we've got an absolute ton of volume sitting in this region. We've got low volume below here, a little bit of lower volume here, but we've also got some really strong volume here, which is really what brought this move to a precipitous end, as expected, following the volatility candle, and we've had this consequent rollover. It's not gone a huge way. That said, we're on the ES here, and when you're talking about these increments here of 5 points from 26.85 to 26.90 and 26.90 to 95, most index traders will be looking for a handful of points on an intraday basis. 2 or 3 or 4 points is all they look for on the ES. That's what they're in this market for, and this is absolutely delivered. As soon as you see these sorts of candles coming in, this weakness, decent volume under it, wick to the upper body, another one, it repeats. It's clearly weak. It has to be. We've got decent volume under there. We're trading around the VPOC anyway, and then the market rolls. What's interesting at the moment is we had decent volume under this candle, so that was not anomalous. In other words, price and volume are in agreement. Price and volume are in agreement on this one, although that said, a little bit of a fall in volume, but no surprise because simply the price action is narrower. So in terms of price agreement, both those two candles are in agreement with their related volume. We've had the rally higher. What's interesting about the rally higher is that the volume on this one was marginally less than this, and yet the price action here was wider, almost twice the width of this one. So you've got a rising market on the same volume. Well, if this is your benchmark, why have we got a market that's risen twice the price spread, but actually on the same amount of volume? So something's not right. It's not looking terribly strong, and we're starting to see it roll over. The trend monitor is bright red. We've got some minor resistance up here at 26.90. And if I just drop that back down again, all of that, of course, is reflected over on the other time frames. This is the 15-minute time frame. And really, this is just what puts everything into context when you're looking at it from the perspective of what is going on in my time frame and what is going on in slightly slower time frames, and giving me that heads up as to whether we're seeing a market that's going to reverse, whether we're seeing a market going into congestion, etc., etc., etc. Nice 2-bar reversal there, which we looked at last week. But this was certainly the price action from the open. Again, down here, this is where we're getting underway. We get this ton of volume coming in, then we get the weakness starting to appear, big wick to the upper section of the candle, closes almost halfway down. Then we get a repeat. It's starting to look very weak. Off we go down the hill. The trend monitor is starting to transition. We've had the uptrend. This went on through this morning where we had very solid price action to the upside. We had a really nice steady trend. There was nothing scary about it. And it also reinforces the point, people who say, well, I can't trade Globex because both markets are not running. Utter tosh. The Globex market is perfectly valid. The volume price relationship is perfectly valid. It's just accepting the fact that obviously volumes per se are that much lower because you're trading an electronic contract as opposed to trading the electronic and the cash markets running in parallel. Other than that, there's absolutely no difference. And in many ways, the price action in Globex, when the cash market is closed, is a little bit more stately in progress. You do get volatility, but you certainly don't get the sort of volatile swings that you tend to see unless you get big news out of China or something in the Far East. Certainly for us at any rate, you don't see those massive volatility that you do see at the open pretty much every day of the week. And then up onto the non-time-based charts. This is on the Renko. We're currently in a congestion phase. Works in exactly the same way. This was the run through this morning. Very solid, very measured. And bear in mind what I said earlier on. This is 5 points over here. For a trader to take 10, 15 points out of the ES is, I would say, nirvana. It's unheard of. But that is what you can achieve with a Renko indicator, which basically smooths out the price action. It is complementary to time-based charts. It's complementary to tick-based charts. It just smooths out that price action and makes everything more even-paced, and obviously smooths out the volatility, because the volatility you see is represented in these regions, for example, where you've got the bricks up and down. And it's just a great way to help to trade these markets, particularly the ES, which is the most volatile of all. And as Anna said, the YM, I mean, in terms of how they perform, I'd say pretty much they rank in that order. You've got the YM and the NQ and the ES, and that really represents their volatility and also the volumes that are traded. The ES is the most heavily traded, then the NQ, then the YM, pretty much in that order, and also in terms of how they perform in the market. So if you're new to index trading, I would suggest you start with the YM, possibly the NQ, but not the ES. The ES is can be a little bit like the pound yen on the forex markets. Just keeping an eye on what's going on at the moment. Let's go and have a look at the other thing I would also say is, sorry, I've got the sun shining on my screen. This is on 5 minute, this is the NQ. And again, when you're trading an index, it's always handy to have the other indices up. They don't always follow one another around, but generally there is a pretty close correlation internally in terms of intraday. As I say, not always. There has been divergence, certainly from a daily perspective, but on an intraday basis, as you can see here, this is the NQ. the derivative of the NASDAQ 100. Pretty much the same sort of price action, pretty much the same sort of volume profiles. And again, you've got the volatility candle triggered here. When you see this market, what happens is, I was watching it at the time, it's a classic trap move for two reasons. Firstly, because you've got volatility, and secondly, because it triggers that emotion of wanting to jump in, the fear of missing out, FOMO. And that is the most powerful emotion of all. And what you see is the market suddenly rushes up like this, and you think, oh, I've got to jump in. I can't miss this move. There's 5, 10, 15 points suddenly gone by. I've got to jump in. That is the natural emotional response that you will get whenever you see a market moving that quickly. It's natural. It happens to us all. We're the same. You just have to sit on your hands and just wait and be patient, either for the price action to be confirmed with a further move, or for reactions, reversals, particularly when the volatility indicator is triggered. And the other thing I'd say about it is that it actually triggered in real time. So as soon as the price action moves outside the average true range, which is how it works, and all average true range is just simply a measure, a mathematical measure of what price action is expected, what price action is normal for that instrument in that time frame. So if you're on a 1 minute chart, a 5 minute chart, an hourly chart, daily chart, doesn't matter. The indicator works. It's the same on MT5 and MT4. It's exactly the same principles. And the reason it's so powerful is because at those points, that is when the market makers and insiders and big operators are at their most active. So it signals many, many different things. It's just a really powerful indicator. You can see here on the NQ, we've got the trend monitor, it's bright red at the moment. We've not transitioned into any other color for the time being. And just down onto the YM, just pop that up full size so you can see that a little bit better. Exactly the same here. We've got this wide candle, volatility, a lot of volume to the underside. The market's rolled over, tries to rally. Then we get this weakness coming in, hitting some minor resistance here. On down the hill we go. And the buying volumes also, excuse me, I'm just going to switch off for a minute. Apologies, for those of you who come along regularly, you'll know we have two dogs who do join in occasionally, Bertie and Harry, so I apologise. They're normally fast asleep, but just woken up, apologies. Sorry, I've switched off for a minute, apologies. The expectation and the anticipation now is, where is the market going next? Well, let's just pull this back. Say we're on the YM now, but you could do this pretty much on all of them right now. That gives you the amount of volume that's sitting in this region. We are trading around the volume point of control, which is this yellow line, which is the fulcrum of the market. In other words, it is the point at which, for the time being, price agreement has been reached with all the various participants, and it is lacking direction. That volume is building, building, building the whole time. It's, as I say, it's the fulcrum. It's like the seesaw. And until we see a strong move away from this region, supported by volume, then the probability is that we are going to continue to oscillate around the volume point of control for the time being. What's also interesting is, if I just pull this wide again, this heavy blue dash line here is, this is a pretty strong platform of support. It was breached temporarily here, but we've gone back inside it again. We've retested it. So below this region, we've got a strong platform of potential support. So for this market to move away from here, certainly to the downside, we've got to get through that and have a clean break through it. We've got another level here down at 24.8820. If we broke through there, we've got low volume down here, but then we've got further price support. The VPOC and support and resistance go hand in hand. The volume point of control is based on, or premised on, using volume as the mechanism by which to judge support and resistance. So in other words, what we're looking at are all these regions up and down the histogram where you're seeing concentrations of volume. In other words, where the price action has paused, you're seeing market participants buying and selling or getting trapped in weak positions. So you're seeing a concentration of volume in those regions. And as those volumes increase, then they become a greater barrier to either advancement or decline of the price action in due course. So it's exactly the same principles as support and resistance, traditional support and resistance, which is based on price action, where you're looking at regions that have been tested, either of resistance, ceiling of resistance, or a platform of support, and those are based on price. But the principles are exactly the same. It's just one works on price action. The volume point of control gives you a visual representation of the concentration of volume in the price region itself, because what the indicator does, it takes time up onto the right-hand side of the chart. So you're looking at the volume price time relationship rather than a relationship which is purely based on price. As you can see, it's no great surprise to see we're oscillating around that at the moment, given where we are, and there's nothing particularly at the moment to suggest otherwise. Up on the tick speedometer, this is basically delivering our tick activity for the ES. You can see we've got 8,000 actual, or 6765 on the Fibonacci, which is nothing to do with Fibonacci other than it's delivering a number which doesn't require you to change the setting quite so often. You can see on the actual, this changes very frequently. This changes slightly less frequency. So if you're trading intraday, it makes life a little bit easier using this number as opposed to the actual. If I'm trading on Globex, I'll use the actual. If I'm trading in these markets, I'll use this one because it means I have to change it less often. I'm not sure what it's set to at the moment. It's currently at 8040 ticks. I'll just change that to a 6765. There we go. Just put a T on the end that does that. So we're on the 6765 tick. So we're running at the right speed now. And that is one of the ways of using the tick speedometer. Tick charts are another non-time-based chart to use in conjunction with time-based charts. The reason non-time-based charts are so popular is because they reveal momentum. They're not governed by time. They reveal the raw momentum of the market, because each of these candles on a tick chart is formed every time 6,765 ticks have gone through. That could be a nanosecond, it could be a microsecond, it could be a millisecond, it could be a second. It's independent of time because that's not the metric that governs the formation of the candle. So when the market's fast moving, then these candles come out very quickly. And that is why, as an intraday trader, it gives you an edge in terms of trading indices, commodities, whatever it may be. You can even run stocks on these. And the reason the market's pretty sluggish right now is where you've got these red regions on the tick speed. This is just giving you a heads up as to inactivity. In other words, the tick activity in these regions is low, the market's sluggish, not particularly going anywhere. That's reinforced with the time-based chart because we're on the 5-minute, we've got the volume point of control here. The 15-minute, we're building volume over here, so we're in a pretty heavy area of traffic on the 15-minute chart as well. The volumes are not really telling us that this market is really going to explode one way or the other right now. Trend monitors transitioned here on 15. You can see we had the nice blue uptrend for most of the morning. We had a little bit of indecision here. Now we're moving into a darker red, so we've got some transitional changes on the trend monitor as we move into the congestion phase. So that's where we are right now, and really not just looking around on the other time frames. Let's just have a look at the other indices. NQ's pretty much the same. That's on the tick, that's on the ES. I'll have to link them together. And let's just there we go. Yeah, so there's not a lot going on right now. That is the daily. One of the charts we always have up. It's very difficult actually to present all this, but certainly you always have a daily chart up because it just gives you, whatever you're doing on an intraday basis, it just gives you a heads up as to what went on yesterday, what were the volumes like yesterday, and what is the expectation, what's the anticipation of what may happen today. Now, yesterday, We had this big hammer candle formed here on the daily chart, hit this minor platform of support down here. A lot of volume, not the highest on the daily chart by any means. That was over here under the initial extreme volatility, but certainly a lot of volume coming in at this level. The expectation is that that is obviously buying volume, so we are starting to see some buying coming into this market. Does it mean the market is going to suddenly rally and recoup all these 200, 300, 400 points here right the way up? The answer is no. But the anticipation is that we may see a recovery. We may be seeing stopping volume coming into this market. We may be coming to a bottom, but the expectation is, given what has gone before, that at the very least we'd probably like to see congestion at this period. We may see a further move lower, but certainly the breaks are coming into this market. We are seeing a lot of buying coming into this market, but given the extent of the fall so far, it's very unlikely, indeed, I wouldn't say impossible, pretty unlikely, this market is suddenly going to rally off one candle. We're going to have to see an awful lot more buying coming into this market, an awful lot more of a return of confidence. As Anna said, these markets are extremely nervous at the moment, very fragile, will react to the slightest bit of negative news and start selling off again. So whilst that's a positive signal, and might give you an indication as to what to expect today, whether that is going to follow through longer term would probably be unlikely. What is more likely is we see congestion, further falls, more buying, more days like this, for example, where the selling pressure is mopped up and the market then rallies thereafter. But that is going to take some time. Let's just go back to see what's going on here. We're back on the ES on 5 minute. We're still rotating around the volume point of control. There's nothing particularly at the moment to suggest that we're going to see anything dramatic. Just depends what happens over the next 5, 10, 15 minutes. The key on the 5 minutes, certainly on the ES at any rate, is that the volume that is sitting below this region, so if we get down anywhere near 2682, or down to 2680, you would expect this market to move pretty quickly through here because there's very little in the way of volume. There's also very little in the way of price support resistance over here to act as a platform if we just drag this right the way over. Looking over to the left of the chart, and I would urge you always to go over to the left of the chart the whole time. It's something you tend to forget about when you're trading, but do check it out the whole time. This is the level at which you'd find some decent price support, possibly down at 2670. So as an intraday trader, looking at this right now, if we break away from the volume point of control with some decent volume, if we get through this level and down into this very thin volume here, then I'd suggest that certainly between 80 and 75, and maybe even down to 70, you'd be looking at 5 to 10 points to take out of the market on some pretty low risk returns or pretty low risk trading opportunities. Just see what happens. Let's just pull that up big size again, makes it a bit easier to see. Trend monitor's gone back into a darker red again because we had this little bit of up rally back into the volume point of control. What we're looking at is obviously the volume. And the thing is that you have to bear in mind, and it's a fact of life when you're a volume trader, is this volume here obviously distorts everything. You can't do anything about that. What you have to try and do in your own mind is look at the volume here, for example, which is pretty heavy compared, this is quite a decent amount of volume compared with this. So you're constantly looking at referring everything within this session. You can't go beyond it because this was Globex running on its own. So it's always comparing the volume within the trading session itself, which is along here. Makes it more difficult. Obviously, the deeper you go in the session, the more volume you have to compare, or you go up and down to different time frames and check it out that way. So if you go down to a 3 minute or a 2 minute, that'll give you a heap more volume as well and also give you another perspective there. Just see if this is going to break this market. I don't have the volume on the updating live because I've got so much data coming in. It does slow it down a little bit, so I tend to have it on the close. So the volume updates on the close. We'll just see if this does break to the downside. And if it does, probably a nice trading opportunity to the short side. Just see if it's same going on the YM. Got the same time frame, so I've got it on 5. We've got a decent platform of support here, but pretty much the same volume profile. So again, on the YM, we can go from, well, quite a fair way low. We can go from 780 almost down to 700. That's 80 points. 80 points on the YM at $5 a point. I'll leave you to do the maths, but it's a nice chunk of change.
John, can you just ask the question about Renko?
Yeah, sure. Sorry, I tend to have the chat box closed. How many ticks in the Renko? Did you mean how many? Yeah, what is the brick size? Let's just close that off. Just want to keep an eye on that because it looks nice. On the Renko, let's just put that up full size, makes it easy to see. I've got this set. This number up here is the number 10. And what that actually means is that as we're trading on the ES, this is actually 1 point. So we've got 1 point on the Renko. And what it does, the Renko optimizer, is you literally choose your time frame. I'm running on a 1 minute, and what the optimizer will tell you is the optimal size to be trading. And it's actually changed right now. It's gone to 9. So in other words, 0.9. So we've gone down from a full point. Now we're down to 0.9 of a point. And it basically delivers that all the time for you. So you're always trading at the optimal Renko setting for that particular instrument. And bear in mind, that changes throughout the day, throughout the trading session. A lot of traders come into this and think that, they'll set, well, I'll set my tick chart at, I don't know, 220 for gold, and I'll set my Renko at 3 points for my index trading, and that's it, job done, or 2 points, whatever it is. This is dynamic. The markets change the whole time. It's what I said earlier on, they speed up and slow down. That's reflected in the optimal setting either for the tick chart or for the Renko chart. So you're actually trading at the speed of the market. So when the market's moving fast, you obviously have an optimal setting that you get through the Renko for that particular time of the market. When it slows down, it changes. It's a constant process. Doesn't mean you have to update it every 5 seconds, but certainly, and it also gives you the flexibility. If you do want to slow it down a little bit and go to a different time frame, you can go to a 2 minute or a 3 minute. That'll give you a larger brick size. I must admit, I tend to stick with the 1 minute myself, but that's how the optimizer works. It delivers, as it says, the optimal setting for the Renko brick size itself. And it works in all markets, whether it's commodities, indices, stocks, spot forex, currency futures, whatever. Let's just see if this is going to break down or whether it's going to pause. Just back on the YM, just testing this platform here. You can see we've got some traditional price support over here as well. So we're going to get through there. Looks as though it's just closing through there as well. That looks pretty nice to me. Let's just go and have a look at the ES. Sorry, that thing keeps jumping up. There we go. There we're on the ES. There we go. So we've gone through that, and we're starting to break lower. And what have we got in terms of volume? We've got nicely rising volume. This one, and this one. This one is very much in agreement here. We've got very minor wicks to top and bottom, a little bit of a wick to the top, which is good. We want to trade to the short side. And once we get through 2678 area, then we should see it go through there relatively rapidly, because there's nothing in the way to prevent it. Again, it's all about patience. It's all about looking at, when you start to see these little flick ups, this rally, you think, oh, no, I've got, I was 10 points up and now I'm 8 points up, and where are we going, etc., etc. You're over here. What are you seeing over on the tick speed? Yeah, we've got tick activity has risen. It's gone green, which is good for us. That's nice. That's what we want to see. So we've got the rising volume, falling price, which is great. That's what we want to see. Over on the Renko, Trend monitor, yeah, we had this little bit of indecision in here in terms of the color, but we've gone back into bright red. The trend dots are sitting above. That's nice. That's what we want to see. Pushing the market down, pushing the whole time. We've got some minor levels of potential support up and down here, but they are minor. They're not terribly strong. The strongest level is down here, this much wider region down at 26.63 odd. And, you know, over onto the tick chart. So that's telling us something. Let's go to the tick. See what's going on there. We've got the trend monitor's nice red. You know, we've got the VPOC. We hit that, breaking away. Trend monitor's back in red there as well. So it's really putting together all the little bits and pieces of the jigsaw puzzle and coming up with something that gives you comfort and makes you comfortable in taking a position in the market. And then it's all about managing the emotion of trying to stay with that market and maximize whatever the opportunity is as it develops in real time. And that's really what it's about. This is just a very small portion, if you will, of what you would have up at any one time. We do get a lot of questions. One of the questions we get asked quite frequently is, you know, what's the optimal number of monitors? I would say minimum, probably an absolute bare minimum 2. I would say the ideal is certainly somewhere between 3 and 4, because that's what you need to have in terms of all the time frames. You've obviously got the associated markets. We haven't even looked at what is going on related markets. You know, you have the yen index, which I've got down here somewhere. You see what's going on in terms of the yen, so you want to keep a track on what is going on in terms of sentiment in the market, because that'll give you another heads up. You'd have the Aussie yen up somewhere. You'd have the currency strength indicator up somewhere, because that would give you a heads up as well. Just go and see, have a look at quick visit to the NQ. Sorry, I've got this one on a white chart. Not quite sure why, but there we go. And again, it's having the 3 indices, because you'll see momentum speed up. Particularly the NQ is particularly sensitive at the moment, because where we are in the economic cycle, the general consensus view, if you will, of the market is that potentially we're coming to start to see a region of the economy where we're getting to that stage where tech stocks, you know, are not the drivers. Tech stocks are the drivers in the primary phase of a reversal out of recession, where you tend to see companies investing and there's lots of IT going in, there's new people coming in, et cetera, et cetera. We're now starting to see that potentially getting to the point at which you have a rotation into other sectors of the market out of the leading aspects of tech stocks and perhaps into more defensive sectors. Let's just drop that out the way again. Let me just switch off for a moment. Can I pass back to you?
No, I was just wrap up anyway.
Okay.
Gold. Have you got gold there?
I have got gold here. Do you want me to pass back to you for a moment?
Yeah, sure, no problem. Sorry,
just
get 30 up.
I'm just going to pass back to Anna just to give you a change in voice. Sorry, I've just pulled up VZ, which is Verizon, which is one of the stocks we've got several actually. Just while Anna's sorting some. Oops, sorry, I just switched my microphone off for a moment. This is Facebook, which you're probably familiar with, or certainly familiar with anyway. I'm sure you know who they are. But this is the daily price for Facebook, who I think report either later today or tomorrow. And this was the huge drop when Facebook dropped from 200 and something down to 175 in a session. It was one of the biggest moves ever, I believe. Absolute ton of volume came in, and this was basically on the release of news that a huge number of Facebook users had their data had been compromised. And that has caused the stock price to continue to fall, as you can see here, We're now down at 145.13, which is not quite $200 from where $100 from where it was, but it's certainly getting on that way. But again, it's two things. First of all, the issue of the distorting effect of this volume bar has on the subsequent volume. And the only way to get around that is really just to pull the screen over like this, so that you actually isolate it out on the left-hand side of the screen. So it's now disappeared. And it gives you a much, much better idea of what is going on. You can look at the volume bars in much greater detail. They're more meaningful as opposed to being very compressed. And as you see throughout, the trend monitor has been pretty much red or bright red. We have this tiny little blue in this this rally here. But again, in the rally, we had lots of volume coming in there, but very weak. We had a wick to the upper body and then another wick, much deeper wick the following day with the same amount of volume. In addition to that, it was running into this very strong level of resistance overhead. We had the volume point of control up here as well. So plenty, and also we've got some decent price resistance over here on the left-hand side too. So plenty of reasons not to expect that rally to last very long, and indeed it didn't. We carry on down. And then we see this really weedy effort, this very weak effort down here to try to rally. It rallied a couple of dollars on the day, but the volume is really not terribly strong. And it's no surprise again to see it run into another load of resistance up here, another level up here, but this was one that capped it off that time. And on down we go, and every time we break through another floor, then you're creating yet more resistance to any rally higher, etc., etc., etc. And of course, the second thing is that once something like that happens, then certainly investor confidence is shaken, and that is going to take some time to be restored. And until you see some significant buying coming into the market in exactly the same way as you expect to see on the indices, until you see that very strong buying come in and sustained buying, it's no good seeing it just on a day. One day is very unlikely to reverse such a dramatic trend. The same is true on the indices. That buying has got to come in over a period of time. On the daily chart, it's going to come in over days and maybe weeks. You'll see congestion building. You'll see the classic accumulation phase building of a market that trades in a relatively narrow range, builds floors and ceilings with volume coming in. And ultimately, what you expect to see is a decline in the selling pressure. In other words, as the market moves in this price range and moves lower, you expect to see less selling associated with that move lower. In other words, you've got to move lower with falling volume, which is signaling weakness. And then you see, obviously, that is generally preceded by buying, by stopping volume, by volume coming in to support the market. And ultimately, the whole thing calms, and then it breaks through what in effect is a ceiling of resistance. You may well see a test develop as a result, and then the market takes off, and below it, it's got a very strong platform, and it's got a ton of buying coming in. That all takes time to develop. It doesn't happen overnight. It doesn't happen in the day. It's all relative. On a 5-minute chart, that phase of price action might last a few hours. On the daily chart, it'll last a few weeks. Time and accumulation and distribution phases are all relative. I'm just going to pass back to Anna. Yeah, no, sorry, just to answer that question, Sam, the volatility indicator is the one that delivers the purple arrows top and bottom. If you've got the MT5, it's on dots, and I think on MT4 it's triangles, so apologies, I don't think we could create triangles on MT5. The yellow triangles are actually a pivot. You can see them there. Anna's just changed screen as I'm talking. That's okay. No, that's fine, that's fine, that's fine. It's exactly the same. The purple, the yellow arrows there are a pivot. That's okay, it's fine all the time. You can stay there. You have to say yes. Okay. We've come back onto my screen, apologies. The yellow triangle here is basically a pivot. And what a pivot does is very simple. It looks at the price action over 3 candles. In other words, these 3 candles here. And what it's telling you is that the high of this candle is higher than the 2 highs of these 2. and also that the low of the candle is higher than these two. And what that means is that you expect some short-term price weakness. It's not a sign of strength, it's a sign of weakness. Temporary it may be, but it's certainly a sign of weakness. What you're seeing with this one here, this is a pivot low. In other words, it's the opposite. The low of the candle here is below the low on either side, and the high of the candle here is below the two highs on either side. And that's what you call a pivot low. Now, not only do they give a view of intraday price weakness and price strength based on that three candle arrangement, the way we use them, and it's something we cover in detail in the education program, is how you use them to help you to define where the market is in its journey. Is it in congestion? Is it moving into congestion? Is it confirmation of trend? Because you've all seen the charts that people put up with two nice trend lines joining everything together, and oh, look at this trend, isn't it fantastic? Well, it's jolly helpful and all that, but actually what you need to know is what's going on at the live edge of the market, not what happened 3 months ago. And that's what the pivot's used for primarily. It helps to define when a market is moving into a congestion phase or when the trend is being developed and a move away and continuation of trend. I hope that answers that one for you, Sam. Just pass back to Anna. I'm just going to try the crosshair, but for some bizarre reason, Anna's cursor goes to the wrong place on the chart. Are you at the middle of the chart? Yeah, that's fine. We'll do it on the crosshair, it's easier.
Oh, thank you. Right, I do apologise. I'm not quite sure why. It's a powerful machine. It's causing all sorts of grief. Right, I mentioned right at the beginning. I said I've been trying out this new app that someone has sent me, and that's basically it's picking up volume anomalies. It doesn't say what those anomalies are. It just says that there's something is happening in the stocks, as it were, and I've just been looking at but normally we use FinViz, and we use a filter such as maybe a 2% change in price, where a 2% change is quite a big change. But one of the ones that was highlighted was Verizon, and it's actually really interesting. It's interesting from all sorts of reasons, and it's the sort of exercise that you may like to carry out for yourself and look at the price action and volume relationship at certain parts of the charts, because what happens is once you start picking it up on charts such as Verizon, we can see here for a start there's not a lot of volatility with this particular chart. I know we had this gap up here. We had quite a dramatic gap up on a reasonable amount of volume, but if you look at the candle that was associated with that volume, what is the first thing it says to you? Well, you've got a very deep wick to the top of the candle, which is suggesting that yes, it looks like a very nice gap, but you've got weakness there. And when traders and investors see that, they think, oh, great, it's going to carry on higher, and it did certainly carry on higher. But each of the candles, in particular this one, for a start, we didn't see any meaningful increase in volume, and then we end up with this candle here, where again we've got a wick to the top of the candle. So it's no surprise to see it come off here, and in fact it also coincides with the volume point of control, as David explained yesterday. This is where earlier on, what am I talking about, where we have volume, price and time, and the importance of the volume point of control. It has elements of market profile in it, so you can almost see it as a sort of what used to be called the value area, where traders, they're happy to transact at this particular point in the chart. And what you also have to look at, the candles, you look at the volume. You see this large candle, this down candle, but look at the volume that's underneath it. Now, a candle of that range, if you like, with that amount of volume, that is another anomaly. So that's basically telling you that ain't going to go very far. And in fact, the very next candle is an up candle with not a huge amount of volume. And yes, I do admit the price does sort of carry on, and we have a candle with a wick to the bottom with a reasonable amount of volume, but it doesn't go very far because it's still rotating around the volume point of control. Then we have a pivot here that we know is going to cap temporarily the price action. We have a candle here with a lot of volume underneath it, but it's a very compressed candle. The body of the candle is very compressed. Again, there is obviously some pressure in wanting the price to go up, but it doesn't go higher and then returns down. Now, because it is around the volume point of control, this is very typical of what you see in this kind of price action. It can, as trader, because what we're seeing is we're not having a clean break, as it were, either one way or another. And the accumulation and distribution indicator that we have, or you would just simply draw a line across there, you have an idea that around the $57.20 area, this happens to be Verizon, but it could be anything, you know that is where your resistance in. This is the range. It's 57 to the upside, and if you like, the VPOC, and just below the VPOC, that is your downside. So it kind of chances along, and you know, you look at the volume underneath the up candles and the down candles. Well, is the volume under the up candles? Is it, you know, is it more positive? Is it is it higher maybe than the down candles? Because you have to try and get a feel for what you should expect as volume candle of a particular range. And by looking at congestion periods, what you can then get a feel for is whether this is likely to break to the upside, or is it actually, you know, the volume point of control is not going to hold, and the instrument or the market is going to go to the downside. But we have this candle here. It is a narrow spread, but there's a lot of volume underneath it. The next candle comes in and it's a down candle, but it's not low volume, but it's not, you know, there isn't enough selling pressure in there. Then the next one comes in, and that is high volume again, and that seems to be the trigger, if you like, for the push away from the VPOC. And the push away, this is what we want to see. You want to see rising prices, but you actually want to see the volume rising as well, as we see here. You don't want to see some up, some down. You know, it's unclear. And this is what we see here until we have this candle where you have a deep wick to not a deepish wick to the top, quite a lot of volume, and that is going to tell you there is weakness now coming in. Now the next candle, which closes within the spread of that candle, if you were to overlay those two candles together, you kind of get a shooting star candle anyway. So you know there is weakness coming in. So you know you have an expectation that this little run up that we had here, which is a really nice run up with rising prices and rising volumes, and suddenly it does come to a pause point. But the most important candle, so if you're not sure of whether maybe this is going to move lower, we have another candle here with a reasonable amount of volume with a wick to the top, and then we have the next one, a down candle, but you know, volume is average. You think, oh well, maybe, you know, it's just a minor pullback. The candle that is really going to grab your attention is this one. And this is important because you have a ton of volume under here, and you have a deep wick to the top of this candle. And this is often a candle that, when it's in a downtrend, is a potential point of re-entry. So if you had taken a short, you know, for whatever reason, you said, you know what, I don't think this is, I think this is run out of steam, as it were. This is the sort of candle and volume combination that you would be looking out for. You'd be looking out for a lot of volume, effort to rise, and then a collapse back. And then we have more, the volume and price is much more in alignment, as it were. But what does it do? It goes straight back into the volume point of control, moves sideways. Yes, it falls below the volume point of control. It goes up, as we can see here. Now, this is Friday. This is Friday when the markets, and you have to remember, this is also against the backdrop. This stock is moving against the backdrop of what the broader indices are doing. So it's not surprising. It's kind of matching what is happening in the broader market. Then Friday we have reasonable volume and we have this doji. Now a doji is not necessarily a candle, a reversal candle. It is a candle of indecision. And by the end of last week, no one was really sure what was going to happen today. And in fact, the market has opened higher, but I can see over on my other screen, it's kind of all running out of puff, David, isn't it? Yeah. And it's also preceded with a hammer, with this stopping volume. It stops actually, quite interestingly, if we look over to the left of the chart, at the very point where we had the initial gap up higher. And this is today's price action. This is the price action today, where we've seen this rush up, as we've seen with a lot of the indices, not supported by a huge amount of volume. Then we have a candle here. Yes, it has a wick to the base at the bottom of the candle, but the volume is really nothing to write home about. The next candle also is an up candle with a wick, but look at the volume again. So what is that telling us? What is this picture telling us? Well, this is really not going to go very far, or at least it's going to, at the very least, it's going to struggle. And if we move down to the 5-minute chart, I did like this chart so much. We can see here, we had this here, ton of volume underneath it with a deep wick. It tried to push higher, but in fact, all it's done is move sideways. And we had the move higher was actually, let's scroll back a little bit, where we had this point here, again, off the VPOC, stopping volume coming in to push it higher. And I have to say, this are not if we were looking at this at the live edge, forget what's happened here. I would have said here, would you agree, Dave? Would you say that was a very positive candle, lots of volume underneath there with a wick to the bottom of the candle? But all I would say here is you do have to read this, especially stocks, as what is happening in the broader market. And in fact, we've seen moving sideways again. It has been drifting higher. And again, this is the point here. We've got a pivot. We've got a very narrow spread candle, not much volume underneath it. And again, it's sort of looking as if it wants to roll over. Is there anything you want to add to that, David?
No, just going back to sorry. Just to go back to what Anna was saying about getting in the downtrend, I cannot tell you the power of that candle with the ton of volume, that one. When you see that in a bearish move lower, and where you often see these is after the market's rolled over, it then moves into a congestion phase. It then perhaps tries to rally a little bit, and then you see one of these, or maybe even see a candle with a very deep wick and a very much smaller body than this, but if you've got decent volume under it, it's such a powerful signal that market is going to carry on rolling lower. So if you didn't get in on the first point, then those are the signals to look out for in a downtrend. They are just immensely powerful in the move low. They're just telling you that the insiders, the market makers, the big operators, they are selling into weakness. They're dumping like mad, and the market's going to fall further and fast, because markets always fall more quickly than ever they do rise. That's what I wanted to add on that. And as you can see on the end here, where we've got this 3-candle arrangement towards the end of the rally higher, that's just classic. It's just classic VPA. You've got a rising market, but you've got falling volume. VPA is all about anticipation. What do you anticipate happening next? Well, you don't anticipate that market is going to continue higher, because the volume's falling away. Price action rising, volume falling is an anomaly. Equally, price action falling and volume falling is an anomaly. Same thing, because markets need volume, they need effort to rise, and they need effort to fall. So if you're seeing anomalies like that, you can pretty much be assured the market's not going to go much further. Simple as that. I just want to switch back over very quickly. I know we're way over time. Very quickly back over onto the indices again. If you can just flip back over here very quickly, just to show you what's going on. There we go. And as I said at the time, this is a very comfortable way of making money very quickly. It's pretty straightforward. There's nothing very difficult about it. You've just got a combination of indicators. Where are we trading now? We're trading down at 26.70. So even allowing for the fact that you might have got in 26.80 or somewhere around about here, when we were breaking through the lower volume regions, you've now got 10 points in the bag. So that's a decent amount of money to make in what, 20-25 minutes, and it's not terribly stressful. This is a sign of weakness. It's market's trying to rally, big wick to the upper body, decent volume under it. We've got a little bit of buying coming in on this candle. You probably can't see it, but we actually have a wick to that candle, and we've got some decent volume there. So certainly as far as where we are right now, if you were holding this position short, you'd certainly be looking at the possibility of a short-term rally at any rate, because we've got some decent volume under this in this buying phase here, which has taken the market 4 points higher. Whether that is enough to cause the market to pause and rally strongly would seem to be unlikely. So from an emotional perspective, what you're looking at is, what do I expect the market to do next? I expect it to maybe pause and maybe go up a little bit. Is that going to cause me a huge change in my emotion from greed to suddenly being overwhelmed with fear? No, because I expect it to happen. So if you expect something to happen, it's, dare I say, it's rather like having a car accident. They cause the shock because you don't expect them. If you expect something to happen, it's less of that emotional shock to the system. And that is another power of VPA. It gives you that anticipation of what is likely to happen next. I suspect the same is going on across all the markets. Just have a quick look at the NQ. That's pretty clean, even better there. As I say, the volatility on the ES is pretty high most of the time. And if you move down to these slightly slower indices of the NQ and the YM, then it's a little bit more measured and a little bit more even paced. You can see there's nothing particularly scary about that particular downtrend, supported by the trend monitors as you'd expect. Just head into the YM. This is on 5, so same time frame. You've got the wick there on this one as well. But certainly looking at those three charts, the one that really is helping, and it does help, is the NQ, because the NQ is really the cleanest of the lot right now. We've got this little bit of a pause point here on the YM and the pause on the ES, but certainly the NQ looks as though it's heading south at a pretty relentless rate. And that again gives you confidence to hold a position in the market. You've got the pivot there, just helping to push the market lower. We've got some price support possibly coming in here, and we've got rising volume. Don't know what's going to happen on this candle here. And that's really what it's about. And you can see up here we've got tick activity, green, that's great, what we want to see, lots of selling, good-o. And down we go, and same on the Renko. A little bit of a pause on the Renko, trend monitor's still red. We've got a pivot here into a little bit of congestion at this phase. See what's happening on the tick. What's the tick count? Pretty much what it was, 67, 65. So no great difference there, but the trend monitor's still red. We've got some price resistance overhead, and that's how you do it. I'm just going to pass back to Anna.
That's brilliant. You're back to my 5-minute Verizon chart, and it's really nice to see just it's kind of drifting. And I was quite surprised about this stock, although it was highlighted as having volatility and anomalous volume. I could see the anomalous volume, but on volatility, I don't really, I can't see that. But it's definitely tracking the the major indices lower, as it were. We'll see what what happens with the rest of the session. And sometimes what can happen is markets quieten down at this time, and then there's a burst of activity towards the end. I think most investors are certainly would be glad to see the end of October and into November, because traditionally we come into that time of the year, once all the earnings are out of the way, is we have our Santa Claus rally, as it were, because the fund managers and the markets, they don't like they don't like the end of the year to end on a bit of a down note. I think we've had a Santa Claus rally every year since the main financial crisis, haven't we? There's always been some kind of rally towards the end of it. But as I said, it's how you look at these, whether are you looking at this chart as an investor, as a trader, or maybe you're looking to write covered calls or some kind of option strategy. You will take from the chart what you need to be able to implement your particular tactics, as it were. But at least if you understand the price action, you understand your candles, you understand what is going on, as I said, with volume, price, and with the time element as well, as we have with the VPOC. As David has said, your emotion, you manage your emotions better. You're not going to be blindsided, or your emotion aren't going to be hijacked, and the fear is going to come in, either a fear of missing out or the fear that, oh my goodness, you've gone into this trade and you've entered this investment, and it's all going to go completely pear-shaped, as it were. Right.
You almost said something else.
Sorry, were you going to say something else?
No, I said you were almost.
I was going to say something, a very rude expression, and we have it in there. I didn't do that. Anyway, I'm really sorry. We have gone over time. We are back tomorrow for our Forex session, and we're going to be looking at the price cycle, overbought, oversold, particularly with a particular view on currency. So I know some of you come along to that as well, and you're more than welcome to join us. But if not, we are back next week, and we'll be back at the usual time. But I'll just finish off, as I mentioned earlier, the indicators that we have using these sessions are the quantum indicators that we have developed for ourselves and are now available to buy from quantumtrading.com. If you want more information on them, please just drop either myself an email, that's anna@annacooling.com, or helpdesk@quantumtrading.com, or david@quantumtrading.com. And the website is www.quantumtrading.com. So thanks very much indeed for coming along. As I said, markets are always very lively, and they just seem to be getting livelier by the day. But whatever you do, stay safe, and we'll catch you next time.